Peter Rose, Longwood Currency Trading. $4,300 left on the table. My screw up. The sad story coming up. It's such a beautiful early morning that I thought I would come out and chat a little bit out here. Well, early morning when you're retired is 8 o'clock in the morning. Okay, probably not early morning for most folks. And it's the 1st of September, actually the 3rd of September of 2022. And weather has turned here in New England from 90-degree heat to 44. It's 44 last night, and it's only supposed to get up to 80 today, and was only up 78 yesterday. And so the seasons progress, and so does the trading. The last, well, quite a few videos that I've done have had to do with well, the turmoil that exists in all the markets, but we see this in the currency markets in particular as all the different countries begin to adjust to the, everybody's having inflation, gas prices are up, heating oil prices are up, people are worried about what's going to happen this winter, and so the futures commodity markets are really rolling around, as well as the currency markets, because the currencies are what pays for the commodities. So they all work together as the interest rates spike around, and we try to get used to what's happening. So those of us that are involved in the currency markets, you don't need to know economics, but you do need to look outside at the world and see what's going on that's causing the movements either to chop or to trend. Or in the case that where you have volatility, you get these periods of trending that will go, 200, 300, 400 pips, and yet some of the retracements that are involved in that trend can be 100 pips or 50 pips. So you can't just play a straight trend, and you can't play a straight, range-bound price action. And the markets really have changed in the last 15 years anyway. Richard Dennis, the famous commodity trader, many years ago, he started with $400 and ran that to $200 million in the commodity markets. And he developed a bunch of turtle traders that he called them. And they went on to great success. And if you read about him and the turtle traders, it's a marvelous story. In any event, he said not too long ago that what they were doing, the turtle traders, and what he was doing, trading these long trends, they would go 4 hour before they would exit a trade. So they were in for the long term. Some of the guys would hold trades for eight months, a year. And he said, the markets have changed, and I don't think my system would really work in the form that it was taught at that particular time. And I think if you listen to interviews from some of those past turtle traders, they would tend to agree with that. And it isn't so much that the markets have changed, or even that the psychology of the traders has changed. I think it's the more rapid availability of information that has provided everyone with a shorter time frame on their decision making. When I started following the commodity market, for example, back in that was back in the early 1980s, I had been doing I had some stocks that I had followed, and I was studying the stock market simply because that was the only market to study. Got involved in some options trading for a few years, and then started studying commodities. And I remember I was getting the commodity charts, and they were mailed to me on a weekly basis. And if you wanted to get quotes, you'd have to go to the Wall Street Journal or Barron's or something like that. I subscribed to the Wall Street Journal. So every day you'd get the quote from the previous day. And so you go and mark that chart. And so retail traders really didn't have access to to all the the frills that we have today. But what the point of that is that we were getting the information that was a day delayed, unless we were actively trading in the market, and then you were calling your broker, buy 3, sell 10, that kind of thing, which I wasn't doing. I didn't trade the commodity markets. But today we have so much information that if someone farts in Bhutan, you're going to know about it in Tallahassee, Florida, in about four seconds. So it's affecting the way that we as retail traders react to those markets, because the information hits us and we think, boom, this is going to happen right now. And what you find in the currency markets is that, for example, take a big bank notice release. You'd think that it would immediately affect the currency market. And so the buildup that you see in prices goes the opposite way. And it's the large institutional traders that are trying to position their portfolios for multi-billions of dollars of orders that are on the desk and coming up, and orders that they're trying to satisfy now and looking ahead in the future and saying, well, we're not quite done right now with what we have to do, so we're going to continue to move the market order flow so that we can satisfy our client orders. And the retail traders look at that and they go, oh, well, the market is going up. And so they all buy and the market goes up. And when the retail traders, when the institutional traders are done fulfilling those blocks of orders that they've been working on for 2 weeks maybe prior to that announcement, they go, well, okay, we're done. We'll sell everything now. And everybody gets caught and they think, oh, this is volatility and all that. Well, yeah, it is volatility. Let's not reduce the fact of that. But it does change the way that we as retail traders have to look at those markets. If we're not aware of the underlying forces that govern the markets, and we don't understand that the information transfer to us in the retail market, because we're not making orders for corporations in a international sense, we're simply trading for our own account. Then if we don't grasp that, then we get caught in that volatility. We're constantly finding ourselves on the wrong side of that because we think that the market should do something, and it should. It's just that it can't do it right now. It's like being on an ocean liner and saying, oh, I got to make a real sharp left-hand turn here. Well, that boat is not going to sharp left-hand turn anyway. No, it's just not going to do it. It's going to take a long time to turn it. And so the passenger will say, well, how come you're not turning the boat? And, the captain's going to say, well, we've got the wheel hard over. It just takes there's a lot of momentum here. And that's what order flow is. The result of that order flow is momentum. And you see that on the charts in the differential between the size of the candle and the current ATR. And so in our trading, I think, and again, this is not dumping on any of you that want to do long-term position trading in the currency markets. I just don't think it's feasible to do that. If you understand the order flow, why would you want to be exposed to a long-term trade when you don't know when what you feel is going to happen will happen? I'm pretty good at putting the pieces together and saying this is what I think should happen. When the interest rates go up, the dollar should go up for the U.S., right? When the Fed raises the interest rates, it increases the value of the dollar because more people want to invest in the United States, and anybody that wants to buy stuff from us, however, does have to pay a higher price, and so the economy tends to suffer when the interest rates go up. And yet it does do good things, but those good things don't happen for a long time. And then when those good things occur, then you don't want such a strong dollar. You want people to say, oh, the dollar's cheap in relationship to my currency. I'm going to go in and I'm going to buy their trains and I'm going to buy their airplane parts and I'm going to buy U.S. cars and all that other kind of stuff. So there's a constant battle and flux between all of the central banks and their interest rate policy. And so you have to take that into account in your trading. You don't have to know any of that stuff. You just have to be aware that retail traders are not controlling where that price is going, other than maybe in the short term when everybody gets together and goes, oh, I think the currency prices should go here, so I'm going to start buying. And then everybody sees that everybody else is buying, and they buy. And it's not necessarily the institutional traders that are doing that. They're just saying, I'll sell into that, because they're trying to get their position done. And after they get done selling into that, they're going to buy it all back. And so it doesn't happen when you think it's going to happen. And because of the shortness of the information that we're basing our judgments on what we should be doing as retail traders, because of the condensed form of the information and the lag in when it's actually going to happen, I don't think you want to be in long-term trade. I was in a trade the other day, and I'm a day trader, as you know, if you've been following my channel. Please read my about as to who I am and what my background is, so you understand that what I'm saying is framed within a solid understanding of the world. But when you are looking at these sorts of trades, if you look at them in terms of days or weeks or whatever that you're going to be in this trade, because you've got a 400 pip profit target, take any distance where prices move 400 pips and look at the retracements and the chatter that goes on there. You can't just look at the daily chart and say, well, I got a good rising trend here over the daily chart over the last 3 months, and it went up 500 pips. Oh, yeah, okay. Take it down to the 5-minute chart, and you're going to see that there's a lot of places along there where that 5-minute chart will drop back 20 to 50 pips and then go on. But if you've got a daily candle that's 100 pips, all you're looking at is a 20% retracement in the price to go 20 pips or 30 pips. And that's nothing in, say, 10 daily candles. What's 50 pips? Well, 50 pips is $50 if you're trading a mini lot, and that's a lot. It's 5% if it, of every 1,000, right? So, do you want to take a 5% running loss, betting that it's only going to be a 20 or 30 pip retracement, when in fact it could retrace 200 pips? Now what are you going to do? Where's your stop? Where do you pull the plug? How do you trade like that? You have to make too many decisions along the way at the wrong time. Based on what? That's just really hard to tell. And so that's why I'm a day trader. But I do get involved in long-term trades. Let me tell you what happens when I get involved in a long-term trade. Had to get some more coffee. What you see in those long-term time frames are these retracements. So if you're going to trade them and you are unsure which you are as to whether that retracement will be the normal 30 pip retracement as opposed to a maybe a minor swing. It's not going to go it's not going to retrace 300 or 400 pips and go in the opposite direction, but it may go 150 pips. You look back on the charts and see what's happened in this 2022 period from say March through where we are right now in September, and that's the kind of thing that you're going to have to deal with, and so that's the kind of stuff that I get caught in when I do a carry trade. I tell you about these massive running losses that I have, and you think, well, that's just crazy. It might be crazy for the amount of bank that I have invested in the trade at that point. It might represent a 10% loss, running loss against the bank that's invested, but it's not more than maybe 2 or 3% of my entire funds available for trading. But it's still a lot of dollars. So at some point you have to rationalize the difference between being percentage-wise okay, but from a dollar-wise you're not okay. I was talking to my wife the other day, and we were just talking about a trade I had been in, and I said, and this is the trade that I was in. I left $4,300 on the table, but I made $1,350 on the trade. And so I was saying, oh, I left all this money on the table. And she goes, yeah, but you made $1,300 for the day. And I go, well, yeah, I could be thankful about that. But the problem here is that the next day I was in a trade, and when I'm trading, because I'm making those decisions as I go, I put way out stops so that it would be a major turn to get me out, but it would be pretty severe dollars. Anyway, that's what happened. Is I had this trade on, and it had been a carry. I carried it overnight, and it was $900 against me. It was $200 in my favor. It was $300 against me. It was chattering in a range. Price was chattering in a range, and that's why I did a carry, because the day before it was moving in my direction, and it went against me, and then it went into chattering because the market's closed. So okay, I'll hold it. I don't want to set a short stop because I know it's going to get triggered and go out on me if it moves in the wrong direction, and I don't want to set a profit target stop by moving it up just to capture $300 or $400 because, you know, at least I make $300 or $400. I'm looking at a big move. I just didn't know when that move was going to happen, right? And I've said that many, many, many times. And so I wake up in the morning, and I'm anywhere from $50 up to $800-900 underwater, which is pretty consistent, but it is starting to move in my direction. And so it does that. It moves in my direction, and I think, oh, that's great. And I have a standing stage in order at that point. It comes down, boom, and it hits my stage order, and now I'm double my position size, and I'm working along, and things are moving okay, and so I get a call, and I've got to go take care of something. So okay, oh, I'll be back. I'll be back. yeah, you'll be back. When I got back, I was $6,000 underwater. The thing had gone, had spiked up like that. Well, holy shit. Then it goes to 7,000. Then it goes to 8,000. I'm going, wait a minute, what's going on here? Then the price swings around and stabilized itself, so I was about $2,000 down. I'm going from an $8,000 down to a $2,000 down position in about 20 minutes. That's the volatility that's going on in this thing. And it continued to go down, and hit my next staging point. Now I'm now now I'm balls deep. Okay, gotta make this thing happen. I get a really nice movement down. I get a phone call. I'm on the phone call. I'm watching the price. It's going down. I go, man, I just got to get out of here. It's $1,600 in my favor. It's $2,000 in my favor. I got a long profit target here I think $3,200 was my profit target. Would have been the value of the trade. So I got to hang up. I got to pay attention here. So I'm looking at this thing. It goes to $1,600 in my favor. It goes to $2,000 in my favor. It goes to $800 in my favor. It goes to, remember, I'm carrying some big size, so this shit's moving around like crazy. I said, I got the volatility. This should go to my profit target. And in fact, I should probably pull my profit target off because this volatility should continue in my direction. And who knows where the price will go. And I can sit here with a button and I can stage in more lots as the thing goes down, and then when it swings against me just even a little bit, I can get out. Well, just as I'm saying that, I'm looking at the shorter term time frame, the 1 minute time frame, and the little candle is going, and I'm going, huh. I go down to the 5 second time frame, and the 5 second candle, which is usually a pip or 2 pips, is now 4 pips, and it is swung up, and the slow, fast moving average has crossed over a 21, and it's going up, and I'm going, whew, this isn't good. In my trading at this point, the even 4 pips is a lot of money to lose, and I've gone from a $2,600 or $2,300 profit to an $1,800 profit, and I'm going, I got to get out of here. So I triggered the close all trade button, and boom, and I'm out. And I made $1,350. And I said, okay, that's the thing that I settled on. And I'm talking to Sue about this, and she said, well, at least you made the $1,350. I said, yeah, but if I wouldn't have got out, that was not a retracement. It was a stagger in the order flow, and that price then spiked down 3 5-minute candles, and it would have given me over a $6,000 gain on that trade. It would have gone $4,300 more in my favor. I think that's about $6,000. So I left about $4,300 on the table by getting out. And again, she said, well, that's okay because you made $1,300. Some people don't make $1,300 in a month. Social Security, average Social Security is about $1,400 a month. So what are you complaining about? I'm not complaining, but if when you have a runner, you don't push that runner for everything that it's worth and get that $3,000 gain, the $4,000 gain, the $6,000 or whatever it is, when you're playing with the larger lot sizes, but even the smaller lot sizes, doesn't make any difference, but it's more pronounced with the larger lot sizes because the dollar value is so much more, right? And so if you get into a trade, let's say this trade that I was in when it went against me, and I was there, and so instead of watching it go till I was 8,000 behind, I had been managing the trade and say, 8 pips, that's enough. I'm wrong here. I'm just going to cut it and run, and clip my loss to $2,500, let's say. Well, that loss then is going to be, if I'm on a regular daily basis, let's just say, making $500, and I take a $2,500 loss, I've lost the week's work by getting out at that level, by being wrong. And so when I am trying to work that price action, I might have wouldn't it be nice to make $500 a day? That's, $100,000 a year if you can do that. So you say, well, that's okay. I'm going to lose $3,000 this time, and I'm going to make $42.80 this time, or and it all balances out and it averages to $500 a day, and you go, wow, that is really good. The problem with that is, what happens if I hit 6 losers in a row of $3,000? Now how's my average $500 a day going to get rid of that huge loss? You have to figure into your calculations those big losses. You can't just do a simple math thing, because the trading isn't simple math. You get puked out like I did. I got spooked in that trade. I took my $1,350 and I'm happy as a clam. But if I would have had some balls and stayed in it and staged more in, I'd have had a $6,000 or $8,000 gain, because I would have continued to stage in. So that would have made up for a lot of these times when I have losses during the day, intraday losses of $1,000 or $2,000, and I'm scrambling around trying to make up that $2,000 loss and then make another $500 so I can close the day 500 up. It makes your life very, very, very difficult, and that difficulty is caused when you're looking for the long profit target. If you're just day trading and you've got, oh, I'm going to get out if it goes 8 to 10 pips against me because the ATR on the 5-minute chart, blah 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 blah, and I'm gonna have a profit target of it's offering me 20 pips. I don't care whether the potential is there that's going to offer me 100 pips. That's not the point. It's going to offer me 20 on a clear momentum drop. I'm confident I can go in there, maybe even go in with a 5 lot to open, or an 8 lot to open, and then stage in as it moves up into toward my profit target. And if it starts to stagger at all around that, oh, I've got, instead of 20 pips, I've got 8. Oh, boom! I can pull it out at 8, and I've got a large dollar amount that I've won. It was only 8 pips, but it's a large dollar amount, and it's the dollar amounts. You can't trade by dollars. You have to trade by pips when you're trading the smaller account size. I've said that so many times. If you're trading 3 full lots or under, you're trading 2 minis or 2 full lots or something like that, you have to go all in, all out, and base it on the pips, not the dollars. Because once you start trading your P&L, you're screwed. But once you get up into the larger account sizes and you start trading $30,000, $40,000, $50,000 or more, you're now beginning to stage and do more sophisticated trade manipulation than you would if you're all in, all out. And now you're trading by the dollars, not by the pips. You still have the pips as your roadmap. You're still saying, oh, I'm looking for 20 pips. And you play that for the 20 pips to make a decent amount of money. But really what you're looking for is to have a lot of dry powder, so that if that thing goes with a momentum jump like what I was going through the other day when I was talking about that price, I got uneasy at the $13.50. I should have just been uneasy. I'd been $8,000 behind. It didn't bother me because I had confidence that it was going to go in the direction that the price ultimately went in. I should have just taken the pain of that reversal. Maybe what would have it gone? In that instance, it might have gone $2,000 against me, turned around and dropped like shit through a goose. I'd have been going in, staging those lots, and I'd have been $6,000 or $7,000 up for the day, to match the $8,000 loss that I had originally had, that I didn't close out, that was up there. This is really important stuff that you try to understand this, even if you're down trading a couple of mini lots, guys, because these are the issues that you're going to be faced with. And if you're not trained correctly when you're working with your mini lots or your low 5-figure account, if you're not getting the straight scoop and the guidance on that, you're going to trade that like a larger account. And when you get to the larger account, you're going to be trading for dollars but not understanding the pips, and you're not going to be successful. Why is it that 90% of the traders lose 90% of their money in 90 days or less? That's the statistic for us retail traders. Why is that? It's because of what people are telling you to do. Watch my videos and send me an email if you have any general questions. I appreciate the comments, and I'll try, if you ask me a question, I'll try to basically help you out there, but it's limited as to what I can do in a comment. So if you have a serious question, put the comment in there and say, hey, I'm going to send you an email with my question, and I tend to get back to you as soon as I can on that. But $4,300 left on the table. Was it an error? I think it was. Even though I took the $1,350, I probably should have stayed. Probably should have stayed the case. It's a good example to talk with you guys about, and I'm glad that you're here listening to it, and I could share it with you. Good trading though for you. Okay, Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.